Welcome to Accounting with Professor Lamptey. In our previous videos, we built the foundation step by step. We started with the accounting equation. Then we looked at debits and credits. We learned how to record journal entries. We walked through the accounting cycle. Then we discussed cash basis versus accrual basis accounting. And in the last lesson, we explained adjusting entries and why they are needed before financial statements are prepared. Now we are ready for the big question. After all the recording, posting, adjusting, and checking, where does all the accounting information go? The answer is financial statements. Financial statements are the final reports that summarize what happened in the business. Think of them as the business report card. But unlike a school report card, financial statements do not say, excellent effort, or talks too much in class. They show numbers, they show performance, they show financial position, they show cash movement, and they help people make decisions. Today, we are going to explain the four main financial statements: the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. Accounting is not just about recording transactions. Accounting is about communicating useful financial information. Business owners need that information. Managers need it, investors need it, banks need it, creditors need it, government agencies need it. Even students need it, especially when the exam says, prepare the financial statements, and suddenly the room becomes very quiet. Financial statements help users answer important questions. Is the business profitable? Does the business own more than it owes? Can the business pay its bills? How much cash came in and went out? Is the business growing or struggling? Financial statements are not just forms. They tell the story of the business. Each statement tells a different part of the story. The income statement tells us whether the business made a profit. The statement of retained earnings explains what happened to retained earnings. The balance sheet shows what the business owns, owes, and the owner's claim at a specific point in time. The statement of cash flows explains how cash moved through the business. Now let's go through each one. The first financial statement is the income statement. The income statement reports a company's revenues and expenses for a period of time. That period could be a month, a quarter, or a year. The purpose of the income statement is to answer one key question: did the business make a profit? The basic formula is revenues minus expenses equals net income. If revenues are greater than expenses, the business has net income. If expenses are greater than revenues, the business has a net loss. Let's use a simple example. Suppose a business earns service revenue of $10,000. During the same period, it has expenses of $7,000. The income statement would show revenues of $10,000, expenses of $7,000, and net income of $3,000. That means the business earned more than it spent during the period. Now let's be careful. Net income is not the same as cash. A business can report net income and still have cash flow problems. Why? Because under accrual accounting, revenue is recorded when earned, and expenses are recorded when incurred. That means some revenue may not have been collected in cash yet. Some expenses may not have been paid in cash yet. So the income statement measures performance, not necessarily cash. That is why we also need the statement of cash flows later. The income statement is important because it shows whether the business is generating profit from its operations, but it is only the first part of the story. The second statement is the statement of retained earnings. Now, this one may sound less exciting. Let's be honest. Nobody wakes up in the morning shouting, "I cannot wait to prepare the statement of retained earnings." But it is important. The statement of retained earnings explains how retained earnings change during the period. Retained earnings represent the portion of profits the business keeps instead of distributing to owners. The basic formula is beginning retained earnings plus net income minus dividends equals ending retained earnings. Beginning retained earnings is the amount the company had at the start of the period. Then we add net income from the income statement because net income increases retained earnings. Then we subtract dividends because dividends are distributions to owners. The result is ending retained earnings. Let's use a simple example. Suppose a company starts the year with retained earnings of $5,000. During the year, it earns net income of $3,000. Then it pays dividends of $1,000. The ending retained earnings would be 5,000 plus 3,000 minus 1,000 equals $7,000. So ending retained earnings is $7,000. Now here's the important connection. Net income comes from the income statement and flows into the statement of retained earnings. That is why the order matters. You prepare the income statement first. Then you prepare the statement of retained earnings. The third statement is the balance sheet. The balance sheet shows the financial position of a business at a specific point in time, not over a period, at a point in time. For example, as of December 31st, as of March 31st, as of the end of the year. The balance sheet is based on the accounting equation. Assets equal liabilities plus equity. Assets are what the business owns or controls. Liabilities are what the business owes. Equity is the owner's claim in the business. The balance sheet answers this question. What does the business have and how was it financed? Let's use a simple example. Suppose a business has cash of $5,000 and equipment of $10,000. Total assets are $15,000. Now suppose the business owes a bank $6,000. That is a liability. The remaining $9,000 belongs to the owner's claim or equity. So the balance sheet would show assets of $15,000, liabilities of $6,000, and equity of $9,000. And the equation balances. 15,000 equals 6,000 plus 9,000. That is why it is called a balance sheet. If it does not balance, something is wrong. And if something is wrong, accounting will find you. Maybe not today, maybe not tomorrow, but it will find you. The fourth financial statement is the statement of cash flows. This statement explains how cash came in and went out during the period. It answers this question: what happened to cash? This is important because the income statement does not fully answer that question. A business may be profitable but still short on cash. For example, a company may make sales on account, meaning customers owe money but have not paid yet. The income statement may show revenue, but the cash may not have arrived. And as we all know, you cannot pay rent with "customers promise to pay me soon." The statement of cash flows helps users understand cash movement. It is usually divided into three sections: operating activities, investing activities, and financing activities. Operating activities involve the main day-to-day business operations. This includes cash received from customers and cash paid for expenses. Investing activities involve buying and selling long-term assets, for example, buying equipment or selling land. Financing activities involve transactions with owners and creditors, for example, borrowing money, repaying loans, issuing stock, or paying dividends. If a business receives cash from customers, that is an operating cash inflow. If it pays employees, that is an operating cash outflow. If it buys equipment, that is an investing cash outflow. If it borrows money from a bank, that is a financing cash inflow. Profit is important, but cash keeps the lights on. And if the lights go off, even the best income statement becomes hard to read. Now let's connect the four statements. This is one of the most important parts of the lesson. The financial statements are prepared in a logical order. First, prepare the income statement. Why? Because we need net income. Second, prepare the statement of retained earnings. Why? Because net income from the income statement is used to update retained earnings. Third, prepare the balance sheet. Why? Because ending retained earnings from the statement of retained earnings is reported in the equity section of the balance sheet. Fourth, prepare the statement of cash flows. Why? Because it explains the change in cash during the period. So the connection looks like this. Income statement gives us net income. Net income flows into retained earnings. Ending retained earnings flows into the balance sheet. Cash connects the statement of cash flows and the balance sheet. Let's bring this back to the accounting equation. The balance sheet is built directly on assets equal liabilities plus equity. But the other statements also connect to the equation. Revenue increases equity because it increases net income. Expenses decrease equity because they reduce net income. Dividends decrease equity because they are distributions to owners. Assets and liabilities are affected by business transactions throughout the period. That is why everything we have learned so far matters. The accounting equation gives us the foundation. Debits and credits give us the recording system. Journal entries capture transactions. The accounting cycle organizes the process. Accrual accounting tells us when to recognize revenues and expenses. Adjusting entries update the accounts, and financial statements communicate the results. That is the big picture. Now let's talk about common mistakes students make with financial statements. The first mistake is confusing the income statement with the balance sheet. The income statement covers a period of time. The balance sheet shows a point in time. That difference matters. The income statement might say, for the year ended December 31st. The balance sheet says, as of December 31st. The second mistake is thinking net income is the same as cash. It is not. Net income measures profitability. Cash flow measures cash movement. A business can have net income but still have cash problems. The third mistake is forgetting that retained earnings connects the income statement and the balance sheet. Net income increases retained earnings. Dividends decrease retained earnings. Ending retained earnings appears in equity on the balance sheet. The fourth mistake is forgetting the accounting equation. The balance sheet must balance. Assets must equal liabilities plus equity. The fifth mistake is preparing the statements in the wrong order. A good order is income statement, statement of retained earnings, balance sheet, statement of cash flows. Let's use a simple recap example. Assume a business has revenue of $10,000 and expenses of $7,000. Net income is $3,000. That goes to the income statement. Now assume beginning retained earnings is $5,000 and dividends are $1,000. Ending retained earnings is $5,000 plus $3,000 minus $1,000 equals $7,000. That goes to the statement of retained earnings. Then ending retained earnings appears in the equity section of the balance sheet. The balance sheet shows assets, liabilities, and equity at the end of the period. Finally, the statement of cash flows explains why cash increased or decreased, so the statements are connected. When you understand the connection, financial statements become less intimidating. You stop seeing 4 separate reports. You begin to see one connected story. Let's recap. Financial statements summarize the results of the accounting process. The income statement reports revenues, expenses, and net income. The statement of retained earnings explains changes in retained earnings. The balance sheet reports assets, liabilities, and equity at a point in time. The statement of cash flows explains cash inflows and cash outflows. The income statement connects to retained earnings through net income. Retained earnings connects to the balance sheet through equity. The balance sheet connects to the accounting equation. And the statement of cash flows explains what happened to cash. So remember this. Financial statements are not just reports. They are the story of the business told through numbers. Thank you for watching Accounting with Professor Lamptey. If this lesson helped you, subscribe for more simple accounting lessons. And remember, learn accounting, think critically, make better decisions. I will see you in the next video.